Now, you mentioned a little bit from a regulatory and financial industry push, right, as well, that co-lending is being pushed a little bit. Obviously, we see the benefit to the ecosystem in terms of access for the customers through credit, through NBFCs and fintechs. So, if you were to fast forward this over the next, let's say, 2 to 4 years, maybe 5 years, how do you see this transforming the industry? Right? Do you see more widespread access to credit at a more affordable credit, more competitive? Do you see, higher risk and higher NPAs happening because of this? Because more people are getting into the credit system. How is the ecosystem thinking about this? Is co-lending, seen as a way to get people into the system, but later on that the banks, because this is the other question that people always have, right? Well, the banks might use this as a way to get the customer, and they build up their credit worthiness, and after that the banks will put aside the NBFCs and the fintechs and directly work with the customers. So how do you see this shaping up?
Right. No, I think these things have come up. At least what we have seen, and many times we have actually, kind of facilitated those also. That banks are typically, and there's kind of an SOP also, that banks are not doing a direct communication with the customer. So they're not sending any email or SMS to the customer, because the customer ownership remains with the NBFC. So here the role is the NBFC has, or the fintech has, a role of basically customer acquisition, servicing, collection, and everything, while bank is primarily the financial investor into the transaction. So they are behind the scenes, they are getting the biggest, they are the one of the biggest beneficiaries of the transaction, but at the same time they are not owning the customer. And this is something which is broadly agreed upon also. I think in terms of how we see it, we see obviously, gradually the equilibrium is going to come. What we are saying is, together, if we talk about from an NBFC's perspective, we know some of the biggest NBFCs sitting on maybe 70, 80,000 crores in balance sheet, and they are looking at mobilizing at least 50% of their balance sheet towards co-lending. So most of the NBFCs we see would basically migrate from anywhere from 10% to 50% of their book. And we know actually some of the smaller NBFCs who have said we'll do only co-lending and nothing else. So they've said we'll do 100% co-lending. So we know that there are people who can move from anywhere 10% to 100% of their balance sheet towards co-lending, because it is just such a lucrative business, right? So from an NBFC perspective, from a bank's perspective, we see, or in a reasonable time, obviously, I think only the time will tell. But what we see, it is reasonable to believe that 10% of the balance sheet will move towards the co-lending. So I think that is a very reasonable assumption, and we can even talk about some of the numbers. There are banks which are taking, these are the large banks, they have taken in a first year target of building a 10,000 crore book each. A second year, maybe 20, 30,000, 4 5 years, they're talking about a 70, 80,000 crore book. So 70, 80,000 crore book, if is built across, let's say 7, 8, 10 banks, we're talking about 7, 8 lakh crores, 10 lakh crores of the co-lending book at the bank's end, plus the NBFC. So which is roughly about 10% of the overall balance sheet, right, of the in the Indian banking system. So we think it's a reasonable to believe that it will somewhere reach there. It might supersede also if it is being taken in the right spirit. In terms of the NPA, as you mentioned, actually, if you ask us, if we think that if the tool is used in the right way, it's only going to reduce the NPA, because right now, what are the two prevailing methods? There is a prevailing method number one, where bank is directly giving the money to the NBFC balance sheet, and they have no control in terms of the underwriting process. They can lend the way they are lending. So they can lend the customer and charge 36% also, and the customer can default, which is essentially the hit to the bank. Or into the other mode, where they are just buying the assets in a pool basis, which is again a pretty much opaque, because they are just going and buying 10,000 crores of assets, 1,000 crore of assets, where they were nowhere involved. Or there is a bit of a filter, but still there is not a very fine tuning in terms of the asset quality, right? So vis-a-vis into this framework, both things getting solved for, because here the bank is directly involved in terms of who is the borrower. The borrower is being sourced in terms of the common lending framework. Yes, it might be slightly riskier than what they are building it right now, but that's a kind of a replacement book, because they are already doing other activities. So those activities will go down and this will go up in terms of, so overall effectively the risk is actually going down. from the balance sheet perspective. That's what
Got it.
probably my thought would be.